Hi, welcome. You are at, am I echoing? I hear myself echoing. This is the debt panel for deals from $0 to $30 million. Thank you, everybody, for coming. So Hunter's done a great job of assembling a group of lenders and advisors here that can handle pretty much any type of transaction that you have, from construction loans, to acquisition loans, refinancings, cash out refis, bridge loans. Any, through the combination of all of us or any of us here can help you with that. So with that, we have 2 commercial banks, 2 advisors, and then we have Michael here, who is at Peachtree, which can pretty much do anything, especially with the recent acquisition of PMC, which is an SBA 7A and 504 advisor. So with that, let's just go down the line. And Jamie, if you could give a quick introduction of Live Oak Bank and what you guys do, and then we will get into the weeds.
Great. Thank you, Peter. Jamie Bourgeois, Managing Director of our Hospitality Finance team at Live Oak Bank. $15 billion in assets, contiguous nationwide U.S. lender, or contiguous U.S. lender, conventional balance sheet. We love construction, core plus, and core transactions.
Christian Rader, I'm an executive director at Wells Fargo in our hospitality finance group, which is an $8 billion loan portfolio solely focused on hotels, cover the country. And so happy to be here today and talking with you all.
Awesome. Michael Harper with Peachtree Group. I run our hotel lending business, historically focused really on the bridge and transitional space, including ground up. And as Peter mentioned, earlier this year, we acquired PMC Commercial Trust. So it's launching us into the government guaranteed lending space, focused on 7As there. So excited to be here today.
Rushi Shah, Magmile Capital, based out of Chicago, run a nationwide debt and equity advisory platform. We do about $1 billion to $1.5 billion in deals annually. Our specialty is CMBS lending, life insurance lending, conventional, and bridge. We're doing deals nationwide. We do all asset classes. 60 to 70% of our flow is hospitality. So happy to be here.
And I'm your moderator, Peter Burke. I run a company called PMZ Realty Capital. Unlike Rushi, all we do is hotels. We've been in business since 2003, headquartered in New York City, nationwide advisory firm, acquisition, mezz, bridge, perm, and I recognize a lot of familiar faces here, so we've done deals with. So with that, let's kick it off. And I thought we'd handle this a little differently. Rather than just each of us talking, we kind of bring up a real life example. And because we have a myriad of different types of lenders here, see how each lender would handle a specific transaction and how they would price it. So this is deals from $0 to $30 million. So let's make the assumption that we are buying a Hampton Inn in Pigeon Forge, Tennessee. It's a $10 million deal. There's a $2 million PIP for it, so it's a $12 million total capitalization. We have Jamie, who's a commercial banker, Christian, who's going to give us, what can you give us, maybe an SBA type format?
I'll defer the SBA to Michael.
All right, okay, SBA to Michael. You can do the CMBS. So let's start with you, Jamie. It's a $10 million acquisition, a $2 million PIP. What can you do for us?
Got in-place cash flow or?
In-place cash flow. It's a 12 debt yield.
12 debt yield, wow.
Yeah, how about that?
Things cranking, all right. 70% leverage. We can do recourse, non-recourse, limited recourse. Half point in, SOFR 250 to 300, depending on recourse structure.
Okay, and SOFR is right now at about 380?
380. We're going to be floating rate 3 + 1 + 1 with a floor.
The 380 plus 250, so you're in the low sixes.
Low sixes, yes, sir.
Now, if I wanted, what's the difference of pricing if I wanted recourse versus non-recourse?
It's typically going to be between 50 and 65, 75 basis points, depending on your.
I'll pay 75 basis points to have non-recourse.
You're really getting me here. Everybody's. Yeah. So we obviously, risk, price, reward, right? Typically, there's going to be favorable treatment for recourse pricing.
Right. Okay.
I was going to say at Wells, very similar. We're more in the 60 to 65% leverage range, but for 3+1+1 structure, going in debt yield around a 12 with good sponsorship, we're in the mid to high 2s as well.
Got it. Okay. What can you do on the SBA or 7A front?
It's a little large for 7A because we cap out at $5 million in government guaranteed unless we do a Perry loan. But we would do either a fixed or floating rate bridge. And, I'm not going to match either their pricing, but we would probably push leverage to maybe $9 million on it, so 75% of cost. And the spread premium for that is probably on a non-recourse. So take Jamie's 275 plus 75. It's probably another 75 bips for the additional 5 points of leverage there. So call it low 400s.
400s over SOFR. So
On an interest-only basis for the whole 3-year term. Yeah.
right, and that's, did you say recourse or non-recourse?
It'd be non-recourse.
Non-recourse. Okay. Rushi, a CMBS deal.
We would do 75% loan to cost deal, which is basically your purchase price plus your PIP plus some closing costs. With 12 debt yield in place, we would be at 315 over 5-year treasury, all interest only. It's completely non-recourse with a new structure that we've invented recently. Cash management, recourse in lieu of cash management. So it's not everybody qualifies for it. You need significant net worth and liquidity. But for people that don't like CMBS or don't like CMBS because it has the cash management, we've incorporated this structure in all our deals. So.
And is there any trigger for cash management?
Yes. So when the regular trigger happens, usually it's 130 DSCR trigger. The sponsor gets a toggle switch. You go in and you email your servicer saying, I don't want cash management, let my recourse be on. And until you have a cure, the recourse stays, meaning you're fully guaranteeing the loan for that period of time during distress. But once you're out, the recourse goes away.
Got it. Okay. Next deal. Actually, let's use the same deal. Same Hampton Inn, but this time it doesn't have any cash flow. The market is weak. A Hilton Garden Inn open next door. The Hilton Garden Inn is stabilizing, so we hope the cash flow is going to come back. But instead of our 12 debt yield, we have a 2 debt yield. So same acquisition. It's a $10 million deal. Substantial sponsor. He'll sign recourse. His recourse means something. Still needs the $2 million PIP. So I'm coming to you. What can you do for me?
We would very respectfully not do that deal.
You would not, but the projections look great. There's a new chip factory opening 5 miles away. So
we would call our friends at Peachtree and say, please help. No, that would not be a good deal.
Fair enough.
Similarly, our primary focus is on stabilized or near stabilized assets. When I say that, like a 12 debt yield is typical target for us. And so to get there, having a clear path to stabilization is important. Just given that it's our focus, most of our portfolio, around 80% of it is non-recourse. So recourse does help with some transitional assets, but a 2% going in debt yield probably be a little low for us.
Okay, you're both dead to me on this.
That's what I'm here for.
Okay, here we go.
Oh, we can still lean in on that, and so
All roads lead to Peachtree.
So we call that unstabilized, right? But if that renovation's actually going to drive some top line, and there's new demand drivers, and you've got the right sponsorship who has a track record in that market, you can get home on that potentially. It's not going to look the same as that 12 debt yield. I'm probably at 65 or 70% of cost. You're probably going to put some structure in of, you're going to have a completion guarantee for the CapEx, and then like an interest and carry guarantee that burns off once you hit call it 10 or 11 debt yield. So you can still get it done. The story's got to be right, and the business plan has to make sense, right? But we can still lean in on that Hampton acquisition if you're getting a new 15-year license. So
Yeah, it would be
You
a
brought
new
enough
fi-
business cards.
And so what would the pricing for what you said on the leverage level?
Yeah.
It's 10 plus 2, it's a $12 million deal.
yeah, so we pulled leverage back, right? If it was stabilized, I'd have gone to 75. We're probably going to cut last dollar at 65 or 70 on this, and then pricing on that is going to gap out probably 100 bips wider of what we were going to do on the more stabilized product. So call it, it's going to have 5 handle in front of it with some recourse too.
500 over SOFR. Okay, so you're around, call it roughly 9%.
Sure.
A 3-year
500s. So.
It'll be 598.
500. No. Yes, you are being recorded, by the way. Okay, Rushi, you and I are both intermediaries, so our job as intermediaries is to bring you a menu of different types of options for people like this. So as an intermediary, what options can you present to me?
600 over. That's it.
That's it, 600 over.
That's what get the deal done.
You're more expensive
Yes.
than Michael.
But I'll get it done. Certainty of execution.
What would the rest of the deal look like?
We probably do a couple more percentage of leverage, interest reserve as opposed to interest and carry guarantee, so slightly higher loan amount. We would size to 70% of cost, maybe 75% of cost, depending on what the exit looks like. It has to exit at 65%, stabilized cash flow. We're going to focus on market RevPAR. So you mentioned projections can't be, can't be unhinged projections.
Right.
What's unhinged?
You can talk about it.
So just to add some more color to that, when Rushi talks about projections, a lot of times what lenders look at projections, they look at the STAR report, how the market's doing, what the RevPAR is in the market, and if your projections kind of make sense in terms of what the market RevPAR is. They usually take some sort of haircut to that, like they look at what the market is, maybe take a 10% haircut and say, okay, they make a bet that you're a competent operator, they believe in this new chip factory coming in, and that's how they kind of get comfortable with projections. Okay, so that's good. So that's a bridge loan. Same deal, Jamie. The Hampton, it hasn't been built yet. I'm going to build it. This is just a piece of dirt. We're going back in time now. It's 5 years ago before I built this Hampton. It's a piece of dirt. I want to build it. It's a $15 million project. I have, let's call it 5 million of equity. So I have, 2/3. I have a third of the equity.
Yep.
Need a construction loan. What can you do for me?
Yeah, so we like the leverage point there.
65%.
65%. Going to be full recourse during construction, okay with burn downs post-construction. Typically going to be a point in, SOFR 300, 3 plus 1 on, post-construction period. Yeah, we actually really like new construction. New always wins in a marketplace. But in 5 years previous, I don't know, that microchip factory may not have even been, an idea yet. So
Right, so you look at, it's construction, so you look at projections.
that's right.
So just give the group a general sense of when you look at projections, what are you looking at? The chip factory hasn't been announced yet.
Yeah, I mean, we really like markets with dynamic demand generators, right? Things that are going to be there for a long period, durable demand generators, education, healthcare, good weekend demand. So we like a good mix of midweek and leisure-oriented markets. So we've done, in the past, we've done a lot of drive-to destination leisure markets. I mean, that stuff has to make sense. You've got to see that stuff can weather economic cycles. But we mostly are trying to find a good mix of corporate and leisure markets.
Okay, and I'm still on you, Jamie.
Yeah, that's
Before we get off this, I actually just checked my bank account, and I don't have $5 million for this project.
We've got a shortfall.
Right, now I only have $3
Yeah.
million. So I actually need an 80% loan. Disregard everything I said. So now I'm coming to you. I want to build this hotel. It's a $15 million loan, a $15 million project. I need a $12 million loan, an 80% loan. Now what?
We would probably tell you that's not the deal for us. We are CPACE friendly, so we do allow take our 65%, layer in some CPACE. We'll let you scale up to 70% loan to cost. We typically like to structure holdbacks with CPACE reserve just to make sure at least the first year or two assessment can get paid. But 80% is probably going to be a touch too.
Can't you
high
get
for us.
past 70% when you use CPACE?
Not with us, no. We consider CPACE to be a debt instrument, not equity. It has debt-like features. So 70% is kind of our.
So regardless of how far the CPACE will let you get up in the capital stack, you're still going to require somebody to put in 30% of real cash equity.
That's right.
Right, got it. Okay, Michael, so now we come to an SBA kind of loan, which I understand can go up to 80%.
Well, it can. What Pigeon Forge and parts of Gatlinburg are rural, so they fit a couple of different things on government guaranteed pieces. It can fit a USDA category where we can press leverage a little bit up to 80. It also fits, I know this because we've done a deal in Gatlinburg nearby that fit the EB5 rural map, and so we were able to press leverage on that. So, you're generally not going to be able to go to any of your banks on that, and that's why these kind of, government guaranteed rural programs exist. So we're actively funding those. So we can lean in. We still got to be able to underwrite an exit. So we're going to check down comp trades. Obviously, market RevPAR and all the projections make sense, and really want to stabilize at sub 65% because on those kind of regional deals, this is your takeout source if you want to underwrite to that commercial bank takeout. So you can press leverage to the extent that you think you're going to really generate value in that asset and stabilize it at a lower attachment point. Jamie mentioned CPACE in Tennessee. You can use it as a tool. It is debt. You're looking at it the right way. Borrowers will always call and say it's an equity tool, but the reality is it's a tax assessment and it's got to be paid and you should reserve for it. But
talk to us about the pricing for that.
yeah, so on the rural deals, we've been pricing those and call it the SOFR 400s to 500s for construction. That's on the
Okay, so that's
side.
so that's around SOFR's around 8% or so 7 and
Yeah, if you use a
around 8%.
450 spread, call it around the 8% today. And then on the USDA loans are going to price off of prime. That's generally going to be prime 1.5 or 2, so ends up similar coupon basis. The USDA loans are going to have full recourse. EB5, can be recourse or non-recourse, but typically do something with a burn off once you stabilize.
And how long does it take to get a USDA loan done?
Longer than it should.
Right. That's what
Longer than it should. It's probably 6 to 9 months is a reasonable expectation. All construction projects take longer than anybody thinks. I don't think we've ever signed one up and closed it in 45 days. Not for lack of trying. There's just a robust diligence process of getting that construction contract based on 100% drawings, making sure contingencies are right. There's more risk to underwrite. Yeah. So.
And I go in the lack of trying. I've tried to do USDA loans. And for those of you that haven't looked, there's a USDA map that shows you could just actually type in an address and it'll show. In very dense areas, like 2/3 of Long Island is actually USDA eligible, which is shocking to me. And there's areas that like one side of the street is not eligible, the other side of the street is. So it's very, very specific. And the USDA is a great program, but it does take, and there's an element of politics to it too, because the government shutdown, and then all of a sudden they run out of money, and you think you had a deal, and they say, yep, we're all good to go, come back to us when we get our next round of funding, which is, in October. So, but if you can get it done in something like that.
Well, and it's a great tool because it is a perm product. It's truly a 25-year permanent loan product that amortizes over the term. As a solution to that is we'll oftentimes write a balance sheet bridge loan. If you do need to move faster and then refinance with the USDA loan once you do get all of the approvals and go through the red tape associated with that. So there is a solution to move faster on it.
Okay, Rushi, my favorite broker. I come to you. I have this piece of land. I want to build a hotel. What options can you give to me that maybe we haven't heard here?
One thing that hasn't been talked about is mezz, because you mentioned higher leverage. I don't know. This is a little bit smaller side of deal, but 15 million or above. There's actually construction mezz available. It's not cheap. It's not pace. It's mezz. It's real mezz. Real mezz today costs 14 to 16%. So, get with it. That's the rate. And we could structure it as mezz or pref. Pref is like 1% higher. What we look at when we see a deal like this is the first thing is, and I invite everybody to look at their deals like this. Look at the star trends analysis. Look at the market RevPAR, and make sure you're having a modest inflationary increase to the market RevPAR for whatever hotel you're building, and make sure that the expense ratios or NOI ratios are in line with market. So a Hampton Inn should be at 35 to 36% NOI flow through as a percentage of revenue, depending on the market you're in. If you're in Cook County, Chicago, it's less, and if you're in Pigeon Forge, Tennessee, it's more. That's how you not get I think the question was, how do you not get lofty or unhinged projections? And then you look at year 3 NOI, you divide it by 12%, whatever loan amount you get, that's your loan amount that's basically what Michael's been talking about, is a takeout. That is like the most important test. Make sure you do that calculation before you call anybody. The solutions that we offer are same. Bridge, there are a lot of bridge funds that are doing, debt funds that are doing construction financing. We could go up to 80% loan to cost, selectively on deals that has a nice takeout on the other side, and it's a clear demand driver.
Do you allow mezz on your people to put mezz? You don't allow mezz, but would you allow preferred equity if it's structured as preferred
we've
equity?
talked about it a lot. I think if mezz doesn't live at the project level, if it lives at the sole member level and is downstream, we've talked about potentially allowing for that. But because we are so flexible with CPACE, we often don't have to have that conversation.
Right. Well, flexible up to 70%. Christian, do you allow mezz on your deals?
Well, I would say with construction, if that's what we're talking about, in general, we do have some construction loans on our books, but we're more selective rather than programmatic. When we do construction, it's typically with sponsors we have a long-standing relationship with, a lot of development experience, well-located branded product, probably a little bit less on proceeds, more in that 50 to 60% range. And recourse is super important. I would say on more stabilized deals, we do allow some mezz when we grade through the capital stack, through the mezz, through the total debt. So we probably are closer to the 70% with mezz as well.
But you cap out at 70%.
Generally, yeah.
But with preferred equity, like Jamie was thinking, you could perhaps get higher.
Yeah, potentially, yeah.
Potentially.
Yeah.
Michael?
We've allowed it on deals where we're cutting a senior a little bit lower, so we will allow mezz. We write mezz loans as well.
That was my next question. You guys write mezz. Put on your mezz lender hat. Again, Peachtree, you wear so many different hats.
Yeah.
So put on your mezz lender.
So we like mezz, but we did $1.4 billion of hotel first mortgages last year, and we did one mezz loan at $3 million behind a conduit loan. So don't do it as often, but we've historically done some construction mezz, but it's generally going to be behind a bank counterparty where we have a relationship and we're getting protections within the intercreditor. And it's the same math of, you're pushing the stack, but they've got to be creating a lot of value to where you can stabilize and get taken out, because the mezz coupons are great in the mid to upper teens, but if you don't get paid off, it's not really justifying the risk profile. So you're doing all the same underwriting, but if we're gonna write mezz, we've got to be very comfortable with our counterparty on the senior side, not just a borrower. But we'll allow mezz selectively. So we do a lot of non-hotel construction lending, and we'll bring in mezz on those.
And I think a lot of the mezz, mezz kind of went out of it, was in favor for a while. I think it's because a lot of deals are coming up short now. The whole mezz / preferred equity, I put them in the same bucket, is coming back. And I think that's, we heard a lot of the other sessions about deals kind of not working. I think that whole mezz market is going to become very active again. I don't know if you feel...
People have a lot of money to put out, and mezz is a good risk. You get equity-like returns with that type risk. I just wanted to clarify one thing. I think there was a lot of discussion about PACE. We want to make sure that PACE is not to be mistaken with mezz. PACE is not mezz. PACE, in my opinion, is a super senior loan. It is senior to the senior loan. So if you think about a stack of loans, it's senior to the senior loan. It always primes your mortgage. It's a great tool, but just saying.
And it's not equity.
It's not equity.
It's definitely not equity.
The outstanding assessment primes your mortgage, right?
Your tax assessment
keep it
primes your
current,
mortgage,
yeah.
which is totally fine. It could be a good, useful tool, but you have to understand the risks.
Which is why we typically will structure around a reserve for that assessment.
It is the only it's the only piece of capital in a stack that cannot be foreclosed on or cannot foreclose. There's no cure.
Which is why we structure with a holdback for that assessment.
Okay, going around again. Jamie, so you didn't like the Hampton deal that had like, a 2 debt yield or something like that. So how important, but you do construction loans, which obviously don't have any cash flow until they're up and built. And you do loans that are stabilized, so somewhere in between there. So how important is a trailing 12 to you?
Yeah, I mean, trailing 12 obviously is important, but I think there's been a ton of volatility in the marketplace now, so sometimes trailing 12 is really not enough to tell the full story, right? I think you actually need sometimes a little bit more than a T12.
Will you do story deals, and how does that look?
No, you're killing me here. No, storybook deals are tough. I think we've tried to get creative in some ways. We just always end up never, reaching full proceeds, or there's something that's just quite, a little bit too far left for us.
Okay, so I'm calling Wells Fargo. So a lot of deals are story deals. There's something happening.
I will say this. So T12, critically important, right? We got to understand in-place cash flow.
There is no cash flow. It's a story deal.
Well, what kind of story? Yeah, I was going to say, if it is a bridge to stabilization and we're saying, hey, this is a 10 debt yield going to a 12 debt yield, right? We're able to understand and lean into a business plan. We can underwrite that, some upside there. I mean, I think with those projections, they have to be credible. They need to have market data that supports the improvement, and it also needs to have a sponsor that has executed on similar business plans. But that said, yes, I mean, we're not going to go from 0 to 12. I think that's probably a bridge too far. But hey, if we're going from a 10 and hey, we just finished a renovation and we're ramping out of it, going to a 12 debt yield, yeah, we can lean in there. We're not solely looking on T12.
Would you really call that a storybook deal, though?
No.
Yeah.
So we're leaning into business plans, but we're not doing blue sky assumptions. Not
You
story.
have to come up with a better word than story, because it makes it sound like we're telling
I
us.
mean, you bought a hotel during COVID, you renovated it, you activated the common areas and the F&B. That business plan didn't work out. Now you had that bridge. Now your loans come up for maturity. You probably have to put fresh equity into that deal because your business plan didn't work out.
I don't want to hear that.
I would call that a storybook deal. Right. That's probably not the right one.
A little bit longer story.
Yeah, that's an epic. Yeah.
Okay, well, all right, so it was a storybook deal.
Stories.
The story came true, and we did a loan here.
different types of
It
stories.
was either a bridge loan or a commercial bank loan. Now it's time for the takeout. So the takeout, either you sell your property or you move to our favorite form of financing, a CMBS loan.
Yes.
So my man Rushi and I both do a lot of CMBS loans, but Rushi, I'll let you talk about CMBS loans, the advantages, the disadvantages, but it's a takeout, not only in the hotel world. Hotels account for maybe, what'd you say, 10% of the CMBS world out there, but all of the other, the shopping centers, office buildings, self-storage, and on and on. A lot of that lives in commercial mortgage-backed securities. Our little niche of what, we all do in hospitality is really a tiny fraction of it, but it's a great takeout to pay off all of these loans. Number one, just to get off the recourse, free up capacity with banks, and also to do a cash out, to put some equity back in your pocket to do your next deal. But talk about some specifics of the CMBS deals, challenges people have had, and how the CMBS has addressed that post-COVID.
I want to start with saying that you could actually do story deals in CMBS. So we just closed a loan for $11 million at the Atlanta Braves Stadium. It's a Wingate, and it had in-place cash flow, but there's only 2 years left on the flag, and the client wants to convert it to Holiday Inn Express or a Hyatt Place or something
An up
different,
flag.
an up flag or same flag. So what we're able to do now, and so CMBS has come a long way. It has evolved just like everything else because it's pure capitalism, right? I mean, it's an originate and sell model. These guys have to survive. It's a massive industry. We're talking about close to $300 billion of loans happening. Not all small loans. There's some large loans that take a bunch of it, but about $100 billion of annual conduit loans, which is what goes from $5 million to $200 million. That's $100 billion of originations. It's a lot of jobs, a lot of people, a lot of underwriters that are relying on this business. This started in 1991. It kind of never went away. It went away for a little bit after Lehman, but and then after COVID or during COVID. But it's always been there. So they have to evolve. Is the one thing I want to say. So going back to this Wingate deal, we were able to structure a language in there that says that you can up flag or same chain scale anytime during the life of the loan, no questions asked, right? So those are the types of structures now CMBS is more open to that gives everybody flexibility. Is it still the greatest and the most flexible product out there? Absolutely not. And it will not beat your community bank. It will not beat your regional bank. But is it going to be the highest leverage non-recourse option in the world? Absolutely yes. Does it come with strings attached? Absolutely yes. It's the golden handcuff, right? But it comes with gold. So.
But and I think a lot of people use it. I mean, we get calls from people who say, and I went to my local bank and I already have $50 million outstanding with them. I've reached the limit, and so their execution is to take it off the local bank's books, because when you do a non-recourse loan, it's not a contingent liability on your balance sheet, but it also reduces the local bank's exposure and it frees them up to do another loan with you. One thing else about non-recourse loan is a lot of people had issues with servicers during COVID, and the servicer wouldn't work with me, but the local bank would, and we don't want to go through that again. And there's some CMBS lenders that have stepped up and said, okay, we understand that. We want to originate CMBS loans. That's what we do. Like Rushi said, there's a tremendous amount of people involved in the process, appraisers, lawyers, engineers, to make CMBS, to make the machine going. So what they've done is said, we'll hold a servicing so that if, X lender does the loan for you, you can actually call them if you have a problem. You can call me, you can call the lender, the broker who originates the deal should be able to help you, rather than having to deal with some random servicer who's working, it's their first job out of college. You're gonna, you feel like you don't get anywhere. So that's a big difference, that kind of post-COVID, to make the whole CMBS universe more user-friendly. And when you're working with an intermediary or you're working with a lender directly, to make sure that you get an understanding of how that's going to work, because it's not going to be that important when you close the loan, but if something happens down the road and you need attention down the road, that will certainly be an important component for you.
I want to add the most important innovation if you will. It's not really innovation, but that has happened, evolution that happened in CMBS business, is they came out with the 5-year loans. Right? Before, the pain was, I have to keep this loan for 10 years and I have to live with it, and 10 years is a very long time. Most funds have 7 years life cycles. Anyway, 5-year loans are a great tool. 5 years is not a tremendous amount of time. So in case you don't like your loan, you can get it taken out by your local bank next time around and not call it a cash out the next time around. And it's 5 years interest only.
Right. Yeah, and talk about, defeasing a loan after, 4 years or something is not a big deal.
Not a big deal. Last 6 months are open, so it's really a 4.5-year loan. And then if you want to, say, prepay it after 4 years, you're only looking at a 6 months of defeasance or yield maintenance, which we would negotiate. The other one quick change that has happened is on the servicing side. What we're doing with a lot of our deals is we're incorporating these days to respond from servicers. So during COVID, servicers were not responding. It was very frustrating for a lot of people. So we're now incorporating, 15 days, 20 days statutory numbers, saying if we send you an inquiry, you have to respond in a certain amount of days back, which is getting servicers sort of perform a bit better.
Right. And the lend, yeah.
I was going to say on the CMBS side, we look to CMBS for our takeout oftentimes. I think the best execution, which you guys both mentioned, is for cash out refinances. That's the perfect place for it. Whereas at the bank side, we don't really do a lot of cash out refinances.
It's funny, from doing this a long time, there's some people who don't care about recourse. They come to us and say, I'll sign just, recourse. And then there's other people who say, show me anything, but I'm only non-recourse. I'm only interested in seeing non-recourse. And it's obviously a personal decision, and people have very strong opinions, usually one way or the other. But there's very few people who say, recourse, non-recourse. They.
Yeah.
Rishi, curious on your Wingate deal that up flagged. What was you said it was cash flowing. What was the debt yield? Because isn't there typically 11% kind of?
Well, 12.5%.
It's 12.5.
12.5% in place debt yield.
Yeah.
Yeah, on Wingate. But any up flag they do, we reserve some cash. They're going to have to do it anyways. The flag is expiring, so they have to do a PIP, whether they keep the same brand or change the brand.
You just have to be aware of your business plan, because that defeasance, if you get a great offer to sell in year 2, you've got that defeasance cost. So you've got to understand your business plan. If you're a super long-term holder,
Right.
cash out all the cents in the world. You're not selling it. There's not a number. You've probably depreciated it. You don't want that cap gains. You're going long. If you're a trader of assets, it's a hard.
your financing always has to match the business plan.
And that's probably the most important thing, is what your strategy is.
Right. How important are flags to Peachtree?
They help. The brands, they add value, right? You look at retail distribution through those channels, that's important. We talk about exit and takeout all the time. Liquidity for, a Hampton Inn. Probably every owner operator in this room would buy a Hampton, and PE will buy Hamptons, and REITs will buy Hamptons. But if I'm financing a boutique, we can still do it. It's probably a higher hurdle on, there's got to be enough demand in that market that you think you can survive.
You do. Will you finance the economy brands? Not naming any names here, but some of the
that's
lesser
yes,
branded, but
absolutely. Through our 7A program, it's virtually all economy brands, whether it's branded or unbranded. You're a little bit more agnostic there. You're underwriting cash flow, and again, that's going to be operator focused for the most part. But we give great weight to brands. We think they add value, but they give you takeout liquidity as well. So we'll do a boutique, but you've got to lean in, and it's got to be somebody that's able to go sell a hotel without the support of a brand reservation system.
Right. Will Wells look at the economy, the lower scale economy brands?
I would say, 80% of our portfolio is branded, to touch on Michael's point. I think it does help a deal. I would say the brands that we're primarily dealing with are the Marriott, Hilton, Hyatt, IHG. But yeah.
So you look for the top, call it the top 5. So if I came with a lower, would you have done a Wyndham? Rushi's deal.
We'll take a look at it, absolutely. We've had deals across all the brands, and I think our primary focus has been on the
On the top 5. Jamie?
We wouldn't be any different than Wells and Christian. I think we would take a look at a Wyndham if it meant a larger relationship that had, those top 5 brands that you guys all spoke about.
Okay, relationships.
That's right.
Okay, we can,
CMBS does economy,
yeah, CMBS will
higher debt yield.
yeah, CMBS will, finance a bench.
Leverage solves every problem. What did you say?
I said CMBS, as long as there's cash flow, CMBS will, finance a bench.
We got to bolt it down to the ground pretty hard, but yeah.
So we can keep going, and I have a bunch of more questions, but I thought we have about 10 minutes left. I'd open it up to the audience. If you guys had questions, we have real live lenders here, and if you want to run some questions by us, we can do that. Does anybody have any questions? Okay, I see a question. Ed.
On the first example, the Hampton Inn in Gatlinburg, wherever, how do we get a fixed rate loan for that?
You can either swap or cap. Those are really kind of the 2 options for most balance sheet lenders.
Yeah, we typically, everything we offer is floating rate. I think we do have a group at Wells Fargo, the franchise finance group, that can offer some fixed rate, but at the end of the day, the easiest way is just to swap.
Again, it goes back to business plan, though. Rate caps you buy up front. So if you're looking to sell 1 to 2 years, you may not want to buy a rate cap. A rate swap might be better for you. Or so it's going back to knowing your business plan, where that interest rate hedge, which product you want to use.
So do you offer that, or do we get it through a third party?
So most banks will, you have to have a swap desk at your bank to do that, or they have to do like a white label. Live Oak is in the process of setting that up, but most rate caps are through like a third party, Chatham or Derivative Logic.
Do you require interest rate caps on your loans just in general?
We would prefer it. I think it makes the conversation with our credit team a little bit easier because it helps mitigate some of that repayment risk during the term of the loan.
Right.
We typically have a hedge requirement as well.
I think it's a good idea. I always advise our clients to buy them. And they're not that expensive now because rates have come down, and it's just great insurance policy.
And what people don't know is that rate cap is actually transferable with the property. So
Or sellable.
Yeah.
exactly, that's what I'm saying. Yeah,
You don't get much for it, but it has some value to it.
it does have some value. That's right.
Okay, I think I saw a question over here. Yes, sir. Hold on 1 second.
Can you guys talk about new market tax credit and how comfortable the banks or the lenders are? New market tax credit.
I don't have experience with that. Does anybody on the panel?
I've done one deal, and it's very difficult right now. I haven't kept up with the new regs, but as of last year, I heard that it's practically not available for hotels because it's like politically
It's tough.
yeah to get done. These guys they really wanna finance like the Goodwills and the charity like that has like a real mission attached to it for new markets. Historic's different story.
Yeah. It's going to add a lot to your legal costs is probably something you need to be aware of. But, as Jamie talked about PACE earlier or MEZ, you're still going to underwrite how much cash equity does your sponsor have in a deal and what's their commitment to that asset. So, we'll look at tax credits in a deal or other structural features, but you're still going to want to see some skin in the game from your ultimate developer.
And you're probably going to want to deal with a bank that can bridge your tax credits too, because that
Right.
legal on legal, like the discussion between the bridge lender and the senior lender can get quite intense, I guess is the
Yeah,
best
you
way.
probably want a lender that's done it before.
That's right.
All right, because brain damage. Okay. Yes, ma'am. Right there. You.
Hi. There was a really great discussion at the Hospitality Hued event on Sunday and a lot of other discussions as we start seeing the makeup of the rooms here at Hunter change. Financing is still a big hurdle for new emerging hotel owners, women and minority owners. What products do your businesses provide for new or non-traditional owners? Or what would you recommend for people who are coming into it for the first time with maybe their first hotel deal?
Yeah. I'll take that. I think 7A is an amazing tool for that. It literally, it's an SBA program, Small Business Administration, and it's to provide financing for those who can't get conventional financing. So it's a permanent product, so it's a 25-year term typically, fully amortizing, and you can go up the stack routinely on a loan to cost basis. We'll write those of 80% plus. So that's more leverage than you can get from your conventional bank lenders. Your governor on that right now is the SBA caps. They support the lenders who do it by giving a government guarantee. That caps out at really $5 million. So it's generally going to be used for either an economy or smaller property. But it is a great tool, and it's what I always point people looking to. If you come try to buy a $100 million hotel for your first asset, I don't think you're going to get a lot of people's attention. So it's good you start small, you build your track record with those, and then you can call Wells Fargo and Live Oak, and they'll do probably your fifth and sixth projects.
So the SBA does have a second program called the 504 program, which is, it's comparable to 7A, except for it's really more oriented towards just purchasing real estate or just purchasing equipment. And so there are ineligible costs within that program, mostly working capital, and some fees that don't count towards eligible costs. But that is also, so that gives you a little bit more runway in terms of cost or purchase price. If you wanted to do a SBA program, that just gives you a little bit more in proceeds. Or USDA, that's also a good option as well.
USDA would be, for a first-time owner, USDA would be great.
Yeah, on a larger, well, you could do small project USDA as well, but.
Okay. And any other questions? Anybody? Yes, sir.
Thank you. They talked about the SBA default rate. Based on what you're seeing in your personal portfolios at your banks, what's the default rate on that's non-SBA? And what is the cause? Is it more like a decrease in the market or just mismanagement?
So I think we've actually done quite well in picking projects and operators. Our default rate is quite low. But when things do default, I think it's sort of this unforeseen market thing that we didn't really account for when we were initially sort of underwriting a loss of a big demand driver, or like just wholesale structural changes in the marketplace. So not cyclical, but like wholesale structural changes that we just couldn't have underwritten or known about when we were initially making the loan. I don't know if that's true for anybody else.
In the CMBS world, the default rate is really low. I mean, for hotels, it's like in the low single digits. So people always think it's CMBS and no personal liability and all that kind of stuff. But still, people who sign up for those loans treat them. Nobody wants to default and treat them in their strong debt yields going in. Treat them like their own.
Yeah, I mean, all of us have pretty robust underwriting, but it's the things that you can't, mitigate in underwriting. At the end of the day, hotels, unlike most commercial real estate, are very much operating businesses. And who's in there running it day to day, that borrower profile is going to drive so much of the success of the project versus, if I'm writing an industrial single tenant deal, I've got a 10-year lease to a credit tenant that's pretty, won't call it brain dead, but it's priced differently. Hotels are harder, and you can make more yield on them, when you execute successfully. But I'd say it's really less market and more borrower specific that drives defaults.
Thank you. We have about a minute left if there's one more question. Otherwise, we're going to wrap up. Any other questions? Okay. Thank you all for coming. Thank you to the panel.
Thanks.
And have a good day.